Hi, I'm Mickey, and this is Lisa and my guide to home buying. It's something that I put together specifically for first-time home buyers, but it doesn't have to be for first-time home buyers because, let's face it, things change over the years. And I have a philosophy in life that nobody likes surprises. Well, unless it's your birthday, that's okay. But the rest of the time, we really want to know how things are supposed to go, so as things are happening, we know if they're going right, they're going wrong, we know where we stand. And I think this guide is a nice way to keep you on track. Now, I'm also going to break this down on my YouTube channel, so if you have specific questions, you might want to check and you can get a specific answer in just a few minutes. But I hope you'll stick with me, and we'll go through the whole steps from beginning to end. And of course, the beginning step is financing. Okay, so let's start with the financing part. And this really is the first step because it's important to know how much home you can afford. It's important for a couple reasons. I've had people that went out looking at homes and found their dream home only to find out that they couldn't finance or had some problems that they weren't aware of that they needed to correct before they could actually buy the house. And that's kind of heartbreaking. I've had other people find out that the home they want didn't really work with the loan program that worked best for them. And that's kind of rough too. So we'd like to get this out of the way so I'm not breaking hearts. So we begin at the beginning with financing. We're going to talk about pre-qualification and getting pre-approved. And these are actually two different things. A pre-qualification is when you contact a lender. You tell them it's okay to pull my credit report, here's my income level. They take you at your word and they go, okay, based on what you're telling me, here's what you're pre-approved for. Well, okay, that's great. But a true pre-approval actually goes a little bit deeper and is a little firmer, and it's something I prefer to use, and it's what I really want when I'm presenting an offer. So it's a good thing to get done up front. Pre-approval, you're going to actually fill out a loan application. They are going to pull your credit score. And obviously this is a big part of what's going to determine if you're going to get a loan or not and what sort of an interest rate you might have in that. So right now, if you look on FHA's website, they say that you have to have a minimum credit score of 620. As of today, most of the banks that I'm dealing with are telling me, you know what, we really want to see a 640. And they can do that. Just because they're using FHA product or conventional product or anybody's product, they can ask for whatever credit score they want. So 620 to 640 is where you want to be in your starting point. The other thing that they're going to look at is your debt-to-income ratio. So how much money do you have coming in versus how much money is going out every month, or how much debt do you have? And that's the big other factor, because that's going to say, depending on that ratio, how much house you can afford. Now, I don't want you to think if you go through this process and either the credit score isn't quite there or the debt-to-income ratio isn't there that you're done. There are things that can be done. It can be fixed. And that's something I handle on a case-by-case basis. But then really, once you've got that information, it's just a matter of figuring out which loan is right for you. So I'm going to start with what most first-time homebuyers start with, FHA Loans, right? FHA, First-Time Homebuyer Assistance Programs. Very popular with first-time homebuyers because it helps you get into a house with about as little money out of pocket as you can, really. So when you're calculating payments, this is what I want you to think about if you're looking at an FHA loan. What's this going to be your cost out of pocket? The first is, of course, you're going to have that 3.5% down payment, which is not bad. 3.5% on the purchase price of the house. Okay, that's going to be factored in, and you'll be paying that back over time. Another thing that's going to come with FHA financing is private mortgage insurance, or PMI. When you see the letters PMI, that's what it stands for. Now, people get confused sometimes and they think, oh great, you know, I've got an insurance policy on my loan if something goes wrong. Well, it's not really your insurance policy. You're actually buying that for the bank. So that if something goes sideways, something unexpected happens, the bank has insurance in there. So that's something that you really want to get off as soon as you can. Private mortgage insurance will fall off after a period of time. They are going to figure after you've made so many payments that you're going to have built up a 20% equity in your home, then it'll naturally fall off. There are other ways to get it to fall off. Also, you have to check with your specific loan. There is generally a date where they won't consider it before that date. But after that, you can sometimes get an appraisal, an opinion of value, show it to your lender and have them drop that off. But, you know, the sooner you get that off, the better. The other two parts of your payment is going to be your escrow, okay? So people say, what's escrow? Escrow is an account that you fill. Part of your payment is going to go into escrow, and it's going to be calculated for your tax bill when that arrives, and to make sure that your homeowner's insurance gets paid on a yearly basis. So basically, part of your loan will collect a 1/12 of each of those expected bills, sit it aside in the escrow account, just kind of sits there and nothing happens to it. But when the bill comes, the money's there and it gets paid. If you're doing an FHA loan, you have to escrow. If you're doing something like conventional, then it's a choice. You can either escrow or not. That's up to you. So the last item that makes a FHA loan is the FHA appraisal. And it's a little bit different than your standard appraisal in that the appraiser is not just determining the value of the home, but is actually looking for items that may not be quite right and may not be up to FHA standards. FHA wants to make sure that first-time home buyers don't get into a house that they perhaps can't handle. So they're looking for certain things. One of the big things is flaking paint. FHA hates flaking paint. They're going to make you scrape it and paint it. They're looking for handrails, actually. FHA likes to see handrails. They like to see steps that are the right height and width and what's determined by code. You know, what is supposed to be there. It's things like that. They're looking for things that are wrong with the house. If an FHA appraiser flags something that's wrong, that item has to be corrected prior to closing. Otherwise, you can't close. There have been some instances when I've been able to get some repairs set up into escrow. And that depends on what bank you're working with and what your lender requires. But 9 times out of 10, that's got to be fixed first, or you're not going to closing. Okay, so that was FHA. Let's talk about conventional product. Conventional product means that you are putting 20% down. Okay, a little higher down payment, but because you're doing that, you have no PMI insurance, which is kind of nice. You also don't have the restrictions on the appraisal like you do with FHA. As long as the house appraised for value, you have no problem. So that's what you often see people who are second-time home buyers, you know, are often using the conventional program. Not always, but often. Now, there are conventional programs out there that will allow you to do 5% to 10% down. It varies bank to bank. It's not entirely standard, but it's out there. The only thing is, if you're doing that, you are going to have your PMI again. You're going to have the private mortgage insurance. However, you can probably drop it off a little bit quicker than you would otherwise. So other products out there, you know what, there's USDA and there are VA loans. Now, these are both interesting in that they are both no money down programs, but they have some pretty good restrictions that go along with them, right? So zero down sounds great. The other restrictions that come in, they are similar but different. So USDA is the U.S. Department of Agriculture. This is a loan that's really meant for rural development. So you are not going to be able to get a USDA loan in the city of Columbus. In fact, the boundaries have changed so much, you've got to go out not too far, but a little bit further than you used to do that. And there are maps available, and I can help you with that also. VA loans, well, these are loans backed by the Veterans Affairs. So these are loans that are specifically for military veterans or veterans of the National Guard, or, I mean, really active members also, but this is for the military. It is a zero down program. You do have a PMI. They have their own little intricacies in that, but really both USDA and VA, except for some of their special rules, are going to feel a lot like an FHA loan, or that sort of a program. All right, so let's talk about actually going out and seeing houses. What should you expect when you're going on showings? And when you get to this point, you've taken care of the pre-approval process, you're ready there. Maybe you've seen some houses on the internet that you want to go see. Your realtor has probably suggested some, and you set it up and you go out and, all right, great, what do we do? Hey, it's not hard. So you've been through houses before. It's the same thing, only you are going to try and walk through and see, is this a house that you feel you can be in for a long time? And, you know, I always ask people up front, how many houses do you think you need to see before you find the right home? And I'm telling you right now, it's different for everybody. I've had people that walked through 2 houses and they knew it was the right one. I've had people that, unfortunately, we went through 60 houses. no lie. And it took us 60 to find the right one. Whatever it takes, I'm in. But you should know that you can't over-quantify it. You know, as careful as you want to be in making sure you're making the right decision, you're going to know. If something's going to tell you, it's going to come to you pretty quickly, and it almost always happens that way. But as you're looking through houses, there are things that the seller expects that you're going to do, and there are things they don't expect you to do. So as you're walking through houses and you're checking out closets, it's okay to open closets. It's okay to open pantries. It's okay to open doors and peek into places that, you know, you want to see what the space is required. You know, or not required, but how much space do you have in those spaces, right? So that's all right. You know, please don't go through their drawers. You know, the common sense things like that. You know, they don't expect you to go through their desk drawers, their dresser drawers, that sort of thing. But beyond that, it's okay to look. I also like to talk to my buyers about, hey, what's expected to stay in the house and what is not. You know, because the internet will talk about lots of things, but really the purchase contract rules at the end of the day. And the Columbus Board contract basically says, if it's attached to the floors, the walls, the ceiling, well, that's expected to stay with the house. Okay? Now, if you have things like things that are expected to stay, so you might have a curtain rod that's screwed into the wall. Well, that's firmly attached. That's expected to stay. You might have a satellite dish. You might have carpeting. Hey, carpeting's expected. You go into a bathroom and the mirrors are attached in such a way, that's expected to stay. Things that you might have to write in that are not necessarily expected to stay would be things like, even though the curtain rod is attached, that curtain, well, that's more decorative, right? That's something that can be changed. So that's something that you would have to make sure you put in the purchase contract if you want it. Oddly enough, even though we all advertise what appliances we're leaving, if we don't write them into the purchase contract, well, they're not attached, right? Your ovens and your refrigerators, and they just kind of sit on the floor. Nobody screwed them down. So we want to make sure we write those in. I often take the extra step if there's a really nice set of appliances in the kitchen upstairs and the basement's got the old set, to make sure I denote, hey, we want the ones that were in the kitchen. You know, nobody get cute now. Not that that happens very often, but I could tell you stories. So that's another thing you kind of want to keep in mind. And then it's just a process of going through different neighborhoods, going through different houses until you are winnowing down what you really like in a house. And don't be surprised if what you thought you really wanted at the beginning is a little different than what you find out you really like at the end, because you know what? As realtors, we're really good at taking pretty pictures, and what you see online is not always going to be what you see in person. So actually going out there and taking a look is going to make a big difference at the end of the day. So once you've gone out, you've looked at houses, you've found the perfect house. You've made an offer, maybe there was some negotiation back and forth, and there you are in contract. Congratulations. So now this is when your loan process really begins. So even though you've been pre-approved and you've got working with a loan officer who's happy to take care of you, your loan really can't begin until you have a house, right? So once you have a purchase contract to give to your lender, that's when everything begins. And they're going to start collecting some things from you. They're going to want to have your most recent pay stubs. They're going to want to see copies of your W-2. They're also going to want to see your last 2 years' tax returns, and they'll get transcripts from the IRS and all that. And at this point, it can feel like it's getting a little painful, you know, because they're asking for one more thing, one more thing, one more thing. Depending on your situation, they might want to see your retirement funds. They might have questions about this or that. They might ask you about deposits. You just don't know until you begin. And I always tell people, you know what, the faster you can get these things in, the better experience you're going to have, because, I'm sorry, but it always is the one more thing syndrome. So the faster you get things in, you can find out what that next thing is, and you don't get down to the end and feel really frantic because you're getting to the end of your period where you're supposed to be closing on the house, and they're still collecting one more thing. So it's just good things to do, okay? They're going to have an appraisal. I like to tell people that, look, you have to understand, this appraisal is not to find the actual value of the house. This appraisal is just to reassure the bank that what they're loaning you is going to be safe, that the house is worth what you're paying for it. So it's not unusual to see an appraisal come in at contract price, maybe a little bit ahead or above, excuse me. So even if you've gotten a great deal on this house and you know you're getting a killer price, you know what, I'm sorry, the appraisal is probably not going to reflect that to you. It's not going to give you the justification that you probably deserve. So once everything is collected and they finally got the last one more thing, the file goes to the underwriter. And the underwriter's whole role in this is to look at everything, make sure it conforms to the loan you're getting, that everything has been collected that needs, that everything looks good, and once they sign off on it, they're going to issue you a loan commitment letter. Now once you've got that, you've got the loan. As long as nothing changes in your world, they've committed that they're lending you that money, and you are ready to go to closing. So let's talk about home inspection, because that's going to be the next step, right? So once you've seen the house, once you've made an offer on the house, you have an accepted contract, and your lender is working away at getting this done, you want to have a home inspection to make sure the home is in the condition you expect it is. So good home inspectors, in my opinion, don't just tell you what's wrong with your house. A good home inspector is going to give you a complete overall view of the condition of your home. So that means they're not going to just tell you this is wrong. They're going to tell you, hey, this is wrong, this is okay, this is something maybe you want to in the next 3 years take a look at. You know what, I'm not going to put the paint trim outside on the inspection report, but you know, next year probably a good idea to put some paint on. I mean, go through the whole process so that when you're done, you have a really good overview of, you know, what your house is. What do inspectors look at? Well, you know, they're going to go under your house, through your house, and over your house. So they're going to look at your plumbing as much as they can. They're going to run every spigot to make sure it's working. They're going to look at your electrical panel. They're going to check your outlets, make sure that's all in good working condition. They're going to play with the appliances. They're going to look at the furnace. They're going to run the air conditioner, if they can. They're going to look at the roof. You know, oftentimes they're going to walk over the roof and make sure everything is okay there. They're looking at the interior, the exterior. They're looking at as much as they can to give you a complete of a report as they possibly can. Now, there are some limitations of a home inspection. The first being they can't look in the walls. So if they can't see it, if it's hidden to everybody, it's hidden to them too. And they can't tell you that sort of a thing. I would like to tell you right now, a general home inspection is not a pest inspection. There are creepy crawlies among us. You need to get a pest inspection. Now, if you're doing some sort of a loan like FHA or VA, USDA, they are going to require one. Conventional often does not. But you know what? If it's that kind of a place, I think you should have it. Good idea. Testing for radon. You know, radon is a thing right now. If you're not familiar with radon, what it is it's a colorless, odorless gas. It comes up through our basements. Before we built houses that were so energy efficient that nothing escapes, they used to be, it came up through our basement, exited through our attics, we never knew it was there. Now it comes into our house and it can't get out. Radon is, at the end of the day, a mild carcinogen. So it's not as bad as living with a smoker, but it's along those lines. And the EPA says that you should have no more than 3.42 parts per million of radon in your house. So radon's not a bad thing to test for. I do have people come to me and say, you know what, Mickey, I don't care about radon, whatever, leave it alone. It's fine, it's up to you. However, I do suggest that, if you're a buyer and you think you might sell this house someday, it'd probably be nice to know if there was radon in it up front so that you could have your sellers fix it for you, than to find out when you're selling it you need to buy a radon system, which is going to run you, somewhere between $1,000 and $1,200. So if we can spend somebody else's money, hey, isn't that better, right? All right. Lead paint testing. Now, back in 1978, there was a law that said we cannot put lead in our paint. And there are disclosure forms out there if your house was built before 1978 to tell you if it's lead paint or not. Well, I got to tell you, at the time of this video, it is 2015. And if there is lead paint out there, I bet it's got a couple coats of paint on top of it. So unless you're in a really old house and you're planning on taking walls down, or it's in that shape that you've got flaking paint here and there and you think it might be old, I don't think I'd worry about a lead paint. But really, it's situational. It's going to depend on the house, so I'm going to have to leave that up to your judgment and your realtors. So let's talk about wells and septic systems. So you're going to find these in more rural areas. You may find it in an area like Pataskala or Reynoldsburg, a house that's been there a while that everybody around them is on the sewer grid, but perhaps they're not. But it's a good idea if you've got a well and septic, you want to do some basic testing for that. So the first, let's talk about the well. You want to do a flow test. You want to make sure that you're getting sufficient water for the house, that you have enough water. That seems important. The other thing is you want to test the quality of the water. You want to make sure that well's in good condition, that you don't have some pathogens or bacteria or something like that in the water that you're consuming. Now, if that does come to happen, hey, wells can be shocked, they can be treated, this is fixable. It's just something you want to know up front. Septic systems are a little bit of a different animal. So a septic system under the ground, there's really no way to effectively test it. I know they will do a dye test for you, and they put the dye in and they kind of watch to see if it comes out, but to my mind, the only way to know if you've got a lot of room in your septic system is to have it pumped out. Have them remove what's in there. Then you know you've got a good system. You know, septics are something you want to take care of because if you do, they can last for hundreds of years. I mean, we have some septic systems out here that are original to the house. I'm talking 1900s. They're fine, they've been taken care of, they work fine. To get one up to code, well, it's kind of expensive. So it's something you want to make sure of up front that you've got handled. So at the end of our inspection period, we roll right into what's called the request for remedy period. And this is your opportunity as the buyer, after your inspections, to go to the homeowner and say, hey, Mr. Seller, in good faith, we found some things that are wrong, and we would please like you to fix them. Now, this is perfectly normal. It happens all the time. You have to realize, though, you are back in negotiations to some extent. You cannot compel the seller to fix things that you want to fix. So it's not unusual to say, hey, you know what, we would like you to fix A, B, C, and D. And the seller might come back and say, well, okay, I can see A and B, but C, no, that's normal wear and tear, and I don't want to do D. It's okay. It's a back and forth until you can find a point of comfort for everybody. One of the things that I try to tell people and make very clear is, hey, you know what? We're going to find things wrong from our home inspection. That's our home inspector's job, right? Was to pick about the house, give us a great overview of what its condition is. It's okay to find things wrong because anything can be fixed, right? It's just a matter of time and money. Now, if you are just completely uncomfortable with the house at the end of your home inspection, this is your opportunity to exit the contract. No, they cannot compel you to buy a house that, you know, is just in a condition that you cannot accept. Now, you still will have to pay your home inspector because he still did his job, but I also have one caveat to that, and that's you really need to find something wrong with the house. There has to be something of a fairly serious nature before you're going to exit the contract for this clause. Now, what I'm talking, what's serious? Well, you know what? It could be structural. That's pretty serious. It could be some plumbing issues. It could be radon. It could be some electrical issues. It could be a roof. What it's probably not going to be is that you're missing door stops or that you've got some tears in your screens. You know, those are not serious things. Really, every house is a little bit different. Every buyer and seller is a little bit different. You just have to go case by case and find that balance. But it certainly can be done. Now, I wanted to take a second and talk about home warranties. So it is very standard in Columbus, Ohio, in the metro area, that when you buy a house, the seller is going to provide you a home warranty. This will start from the day of closing, goes generally for 365 days, for that full year. What this is for is to cover things that might go wrong during the first year that you're in your house. So it's there to cover things like electrical issues, plumbing issues, maybe appliance issues, you know, things that happen within the house. How this works is you would contact your home warranty company. By the way, if you do have something go wrong, it's important that you don't try to fix it yourself and that you don't call somebody else in first. That voids your warranty. You want to call the home warranty people first. There's generally a deductible. Usually it's about $100. It's a service call fee, if you will, to have somebody come out, take a look at it, decide if you fall under the warranty parameters, and then get it fixed. Here's what I always tell my buyers. I think if we can get the sellers to buy you a home warranty, that's great. That's another level of protection that I'm really happy for you to have. However, home warranties can cost anywhere between $500 and $700. They can go up from there if you're adding coverages like jacuzzis or pools or maybe well and septic systems, things outside the home that wouldn't normally be covered during a home warranty, just a general home warranty. I like to tell people that if you're going to be spending $500 to $700 a year on a home warranty and then have a $100 deductible for somebody to come out to your house, I think you're much better off putting in a special savings account, putting aside $500 to $700 a year. Let that grow to a couple $1,000s, maybe $3,000, whatever you're comfortable with. But building your own contingency plan instead of paying a home warranty company and hoping that the disaster that finally strikes is covered. Not that they're bad, they do a nice job, but you have to know it's not 100% coverage. It's probably only 98%. So I've often had people ask me, hey Mickey, Earnest Money. We've heard about Earnest Money. What is it? Well, I like to explain Earnest Money this way. So in the purchase contract as a buyer, you have a lot of protections written right in for you. So if your financing doesn't go the way we expect, you have the right to exit the contract. Can't make you buy the house. If the inspections don't go the way we hope and you're not comfortable with the condition of the property, you can walk away. There's even a clause that says, hey, if the property is damaged or destroyed in such a way that this is just not the same house that you went into contract with, you have every right to exit the purchase contract. The seller doesn't have all those protections. All the seller really has is earnest money. And earnest money is promissory money. It's money that you put aside and you're saying to the seller, hey, I am so serious I'm going to buy your house that I'm putting aside this, maybe it's $500, more likely it's $1,000 and maybe a little bit more, and I'm going to put that aside. And we understand that if the financing goes wrong and the home inspections go badly, hey, I have the right to exit the contract. But if for some reason I exit the contract for a reason not stated in there, Mr. Seller, you get to keep my earnest money. Okay, so earnest money, it is collected up front, it's collected as a check, it's generally held by one of the two brokerages involved, and it goes into their non-interest bearing account, so they can't make money on your earnest money. This check then comes back to you at closing. You can use this for your closing costs, but you can't use it for your down payment. I don't know why. It has been, in my experience, I think I've only had maybe 2 or 3 people lose their earnest money. And each time it was because they surprised me somewhere towards the end of their transaction and decided that this was just not the house for them. And I tried my best, but you have to follow the contract, and if you are in fault, you could lose your earnest money to the sellers. And that's the way it goes. I hate to see it. But I always tell my people, let me know what's going on. Keep me in the loop. Get me if you have doubts, if you have worries, give them to me up front so we can get ahead of whatever and I can make sure that everything's happening the way it needs to for you. So, what are the residential property disclosure forms? Well, these are basically a 5-page questionnaire that every homeowner, or seller I should say, in the state of Ohio has to fill out honestly and openly. And it is basically a 5-page questionnaire that asks simple questions like, where does your water come from? Are you on a well or are you on a public water system? Where does it go? Have you had any trouble with your electrical? Have you had water in your basement? Have you had leaks in your roof? Have you had any structural problems that we might want to know about? Is there a homeowners association? Just lots and lots of general questions that gives you an idea of what the house has been through, what is currently happening, a little bit about the neighborhood, just to give you an idea, make you a more informed consumer. Now, here's how I feel about property disclosure forms. I think that's great. But you know what? We still want to have our home inspections. We won't hang our hat on it. And it's been my experience that people are very honest when they fill these forms out. However, they forget things. You've been in a house in a long time. Maybe you had a problem in the attic and it was solved and you forget to put it on your disclosure form. Happens all the time. But you know, they're nice to have. They are required by law. In the purchase contract, it actually states that if you are not given a property disclosure form, you don't have to buy the house. So that's your protection. Another disclosure form that you're going to see if you buy a house that was built before 1978 is the lead paint disclosure form, which is again a very simple form, just one page. It asks a seller, are you aware of any lead paint in your house? It asks them if they have any documentation stating that they would have it, and then it has some places for you to sign off to acknowledge that you've received this. So just something that the state's trying to do to protect buyers and sellers during their real estate transactions. So as we get towards the end of our transaction, we're going to be involved with the title company. You know, so what's the title company? Why is the title company involved? Well, the title company wears a couple different hats during this transaction. Now, in some areas of the country, and even some areas of Ohio, you don't just have a real estate agent that helps you with your transaction. You're also going to have your own personal real estate attorney. And your real estate agent will help you find the house, do all the negotiating, get everything set and into contract, and then would hand the contract to your real estate attorney, who would follow it to the end. Well, in our market, realtors do it all. We take it from the beginning to the end. So we still need an attorney to be involved, and that attorney is in the title company. So the title company has several different roles, but basically they are handling all the legal aspects of the transaction. Now this starts with actually researching the title. So when they're researching the title, they're looking for two things, really. One, they're trying to make sure that who owns the property. They want to make sure that the people on the purchase contract are all the owners. Because you don't want to have somebody knock on your door a few years later and go, hey, I never sold my interest in this property, which room's mine? That seems uncomfortable. So we want to make sure that all the sellers are on the purchase contract. The other thing they're doing is researching to see what liens are on the property. So liens are going to be things like the mortgage on the property, right? It might be mechanics liens. Work that was done, maybe plumbers, roofers, contractors who have not been paid yet, and might attach a lien to make sure they get paid. I've also, in several years now, seen credit card liens crop up, which I've never seen before, but things change. Now the title company is going to make sure whatever you're paying for the property is going to clear all those liens at closing. And that's very important because in Ohio, the debt runs with the land. Which is to say, if you knocked on somebody's door and said, hey, I'll buy your house for $100, and they said, sure, and you transferred the title and you did a deed and all that good stuff, and you now own the house, well, congratulations, you not just bought a house, but you bought the mortgages and the mechanics liens and whatever money was attached to that. So we want to make sure that that's not happening. And there's several instruments that help do that, but that's their primary goal. Now, within the purchase contract, the seller is going to be buying you a title commitment or a title binder. This is basically title insurance. So this is insurance for you so that if the title company screws up and they miss a owner or a lien crops up after closing, you've got an insurance policy in place that's going to help you deal with that situation. The other responsibility of the title company is to draw up whatever documents are needed for this transaction. So they're going to draw up deeds. They're going to draw up whatever your lender wants. They're going to draw up a mortgage the way the lender wants to see it. They're going to draw up whatever documents that the lender feels is appropriate for your type of loan. While this is happening in that transaction, they're going to you get to that loan commitment, and then the lender sends closing instructions, and the title company works up all the paperwork, and they send them back, and the lender says that's it, and then you've got paperwork that's ready to sign. So once we get to that point, it's time to go to closing. So what we do is we do roundtable closings in this area, which is to say all parties sit down together, the sellers, the buyers, the agents, whoever's involved in the transaction. They all sit down together at once to go over all the figures, to go over all the paperwork, and to sign all the documents. The closer's responsibility in this is to explain everything to all parties involved so everybody is comfortable and aware of what's happening and knows what they're signing. Now, it's been my experience that one of the trickier things is the settlement statement or the closing statement is all the numbers. because as much as the government keeps trying to put them in order for us so we can understand, it gets a little confusing. One of the more confusing things, I think, is the tax proration. Because in our area, we pay taxes in arrears, which is to say when we're paying our 6-month tax bill, we're not paying it for this year, but we're paying it for last year. So taxes are always kind of stretched back, paid in arrears, and it's the title company's responsibility to, at closing, collect an amount of money from the seller to pay the tax bill that comes to you as the buyer for that period of time that you didn't live in the house. Now, that money will either be put in one of two places. It'll either go to you directly, perhaps into your escrow account, so when the tax bill comes, the money's ready to go out, or it's going to perhaps be paid directly, if it's that time of year, that the title company will just take that and pay that bill as they're supposed to. And that leads me to another part of the title company's responsibilities. It's to handle all the funds in the transaction. So the title company is going to take your down payment, if you have one. They're going to collect the money for the loan to buy the house from the lender. They're going to take that money, and first they're going to pay off any liens on the property. We wanted all those liens cleared, right? Then they're going to pay real estate commissions. Yay! That's kind of a neat part for me. Then they're going to take whatever money's left over and they're going to give that to the seller. And that's the seller's realized proceeds from the transaction of selling their house to you. Now, the responsibilities don't end quite there. They are also responsible for, after closing, for making sure that they take the deed. A deed is a legal instrument that actually tells the courthouse to change the title from the seller's name to your name. So once that deed is filed, the title is in your name. You will get a copy at some point. It can sometimes take a couple months, but you'll get a copy of your title at that point showing that you are now the legal owner of your property. Congratulations. And that's closing in a nutshell. And so that's Mickey and Lisa's Guide to Home Buying. I hope you found it very informative. I know there was other topics and other things I'd like to talk about or would have liked to talk about, but I didn't want to make it any longer than it already was. So if you've got any questions, or I didn't explain something very well, or there was something I didn't cover, feel free to reach out to me, give me a call, ask me a question through YouTube, send me an email. I'm always available. I'm very happy to help you with any questions you might have. And I hope that you watch some more of our videos, and beyond else, have a wonderful day. Take care now.